Ant's first idea is Canadian Natural Resources. And actually, we were looking at that stock earlier. It hit its highest today in at least a year.
Yeah, CNQ, I think, as we talked about earlier, I do see a technical opportunity in this energy space. And I think oil stocks are kind of turning upward again now, rotating, I believe, strongly from this growth to value. And with, again, oil kind of recently topping that $80 a barrel, CNQ has, industry leading free cash flow. It provides a robust, sustainable business and dividends for shareholders, over 4.4% dividend yield. Its debt reduction and efficiency focus over the next few years puts the company at a better long-term position to endure kind of cyclical turns. So we think it's a really well-run business. They've had amazing revenue growth in the last 10 years, still seeing some attractive valuations in that space. And CNQ, we think is still a good value with more upside. So for me, target price in 91 still was at 10% expected growth, plus the 4.3% dividend. Also, weaker U.S. dollar will benefit kind of all commodities. So, which is kind of why we're starting to rotate back into the space tactically after taking profits.
I know it's a philosophical question, but you wouldn't go for a more volatile oil company such as MEG or Athabasca. That they tend to go up and down rapidly with oil prices.
Yeah, I think to us, again, just potentially headed into a recession in Q4, we want to still be in quality companies with good, strong balance sheets. And I think that really CNQ is one of those companies, stable, great business, not as volatile. Yeah, maybe you could squeeze a little bit more extra room out of some of those other ones. But for us, we're not looking to have these huge rapid swings of volatility. We want to take profits, be in stable, good businesses.
Okay, and then your next idea, it's a favorite among oil and gas investors, Tourmaline Oil.
Yeah, Tourmaline. So Canada's top kind of natural gas producer. It has about 25% it is about 25% as big as CNQ in market cap, but roughly 40% of the production. So the price of natural gas was really, temporarily depressed. So we believe that presents an opportunity here. Target price on the street around $85, which still gives us expected return of 28%, plus the dividend of around 1.5. From a value score, it's a 9 out of 10 10 out of 10 perfect value score, and 9 out of 10 fundamentally. So good business, and consensus on the street is outperformed. So we believe that Tourmaline is positioned to improve their financial resiliency and kind of boost these shareholder returns. So we're continuing to build a larger position in our portfolios, even ahead of CPG, Baytex, and Vermilion. So another also common institutionally held stock is actually has a 100% buy rating from all analysts who cover it.
Yeah, Vermilion's interesting because, of course, it has the European gas exposure.
Yeah, and even with Tourmaline, I think that we still think that it is a little bit different, but still right now it's hitting its 50-day moving average. So for us, even from a technical perspective, it is kind of looking like not a bad entry point here, looking at even between the Bollinger Bands.
Oh, okay. And then finally, your final idea, Merck & Company, the pharma giant.
Yes. So pharmaceutical company. Again, we are overweight healthcare in the sector as a whole, but we believe that Merck, has a very diverse division. It covers anything from medicine, vaccines, animal health, healthcare products, and is really kind of attractive in my opinion. So their earnings have steadily climbed for years, and the stock's up over 20% over the past 12 months. Despite being pretty flat, if not flat, year to date. So it's gained around over 5% just in the month of August alone. So this could be the start of its uptrend. The stock remains attractively valued for us, solid business, and we believe is poised for further upside from here. So I think the company reported better than expected results in earnings and sales. even further, they increased their guidance. So that's great for the rest of the year. And again, we're still like the healthcare as a favored defensive sector to not just manage volatility, but also to position the portfolio to be able to weather a potential recession. So they raised their sales outlook for 2023, and the company does expect revenue to be in that range of 58 to 59 billion in 2023, compared to 57 to 58 previously.
Brianne, thank you very much indeed for joining us. First idea is a stock that is trading near record highs, Alimentation Couche-Tard.
That's right, Andrew. This is the world's second largest convenience store operator, over 13,000 stores in Canada, in the United States, in Europe, and even in Hong Kong. It's very profitable. Company earns a 25% return on its shareholders' equity, grows quickly. It's compounded earnings per share at a 21% pace over the last decade. And in brief, the strategy here is to use their procurement clout to price sharply on fuel. And that way you draw traffic to your site, and then you lure shoppers into attractive, modern, well-merchandised stores and sell them all the add-ons. So the coffee, the donut, the chocolate bar, the cigarettes, the six-pack of beer in the United States, whatever. And all that in-store merchandise carries margins, gross margins that are 3 to 5 times higher than what they earn on fuel. So a very sharp operator, also a very capable acquirer of this still very fragmented industry. And in fact, just earlier this year, the company inked a deal to buy 2,200 stores in Germany, Belgium, Luxembourg, and Holland. So the company is increasingly pivoting towards organic growth, better merchandising sophistication. Better organic growth usually attracts a higher trading multiple, so we think there will continue to be re-rating and ongoing growth here for quite some time to come.
We're tight for time. Royal Bank would be among your favorite financial stocks?
Yes, so this is the largest company in Canada. It's one of the 10 largest banks in the world. It's got a dominant personal and commercial banking franchise here, a top 10 global capital markets business, the dominant wealth management franchise in Canada, and a couple of smaller units. It's a leader in digital adoption, artificial intelligence. It's using those tools to drive growth. And with the shares right now yielding 4.5% and the dividend having grown at a compound pace of 7% over the last decade, again, we put the two together and we see a highly visible path to a double-digit total return over a decade. And it's not for nothing that this company has outperformed the TSX in 19 of the last 25 years. We think it will continue that pattern in the years to come.
And then finally, Public Storage, New York listed PSA.
That's right. So this is an acquirer, a developer, an owner, an operator, and builder of self-storage units. It's the largest such company in the United States. It's fairly uniquely advantaged among real estate investment trusts these days in the sense that it's growing its funds flow from operations at a high single-digit pace. A lot of real estate exposures like office and retail are quite disadvantaged in the post-COVID reality. You know, they're vacant, let's say, but these aren't. We all need places to put our bread makers and our Pelotons we bought.
Instead of selling them?
Yeah, that's right. That's right. So, you know, they're managing to grow because they have pricing power. They're increasing their rental rates at a high single-digit pace. It's a sticky kind of a contract because once you put your stuff there, you know, unless you're going to sell it or throw it away, you got to keep renting units. So they're right now experiencing record tenant lengths of stay. They're running a tight ship with cost containment initiatives, energy efficiency initiatives, things like putting solar panels on the buildings, that sort of thing. So again here, the dividend yield is 4.3%. It's grown the dividend at a high single-digit pace, and you know, that's all supported by organic growth, new builds, and targeted acquisitions. So we think they'll continue to hold the dominant position in that industry, which we don't think is ever going away. And so we're very comfortable owning and buying the shares here, and they are trading towards the lower end of their 52-week trading range as well, I will say.
I like that, your bread makers and your Pelotons. Yeah, this lumber we acquire in life. And also stuff from older relatives who passed on. You get the China set and you can't bring yourself to throw it away.
Well, you know, this is not an investment tip, but this is a good tip for everyone. If you've got something and you haven't used it in a year, you probably don't need it.
That's right, yeah. Yeah, Maybe a company should offer a service. We'll put it in storage, but after a year, they just throw it out for you. Save you the pain.
That's right. That's right.
Thank you very much, Brian.
It's great to be here. Thank you, Andrew.
First idea is in animal health, Zoetis.
Yeah, so Zoetis is an industry leader in the animal health space, not just pets or companion animals, but also livestock. So they've made a number of acquisitions over the years. They've grown organically. It's interesting. The whole industry grows at about 5% a year. Zoetis has been growing at about 8%. And if you think about where's that growth come from, well, we know the pandemic was really strong for people having pets. We know there's been a lot of issues with livestock. Think about chicken or beef. So they've benefited from some of those issues. But they're really building a business now to tackle every area along that chain. So we think it's in a really great position with great leadership to be able to continue to grow in excess of the industry. And when we were looking at this name, maybe we bought it last year at some point. I don't remember exactly, but they have 40% EBITDA margins. So all of this growth, a lot of it really flows to the bottom line. Really nice free cash flow from this business, exceptional balance sheet. The valuation as a result of all of these things combined, it's never one of those names that you can get for a good valuation or really cheap like a Costco, but it's an exposure that we think we want to own, for the long term. And especially if you think about Zoetis versus some of the other traditional pharma companies on the human side, they don't have the same pressures from generics. They don't have the same, they have a much stronger pricing power as well. So we quite like this name and continue to hold it.
Your next idea is CAE, a play on the explosion in global aviation.
Yeah, well, that's exactly it, right? And it's not just aviation, it's pilot shortages, it's the need for training and new planes that are coming out now and the training that's required there. We keep on hearing, we follow Exchange Income Fund, they're buying a simulator because they can't get enough time with other simulators. They have to send their pilot trainees all over the place to get them. So there's just an incredible amount of demand for simulators for CAE. But what's interesting about it is they've got the commercial side, which has been very strong, and they've got a defense side as well. So they work with various militaries as well on the training side and the simulation side. And they had a couple hiccups on that side of the business with costs. And so that's been a big overhang on the stock for the last few quarters, but they've shown that they can dig out of that and start to slowly improve that business while the commercial side's just off to the races. So we think it's just a matter of time before this business gets a higher multiple because of the quality of the business, the recurring revenue nature of the business, the strong backlog. They just have to shake some of that defense stuff off that bogged them down over 3 or 4 quarters ago, which they're successfully doing. So we think it's a great time to buy it. I mean, every day there seems to be a new announcement of some partnership that they're forming, which just continues to grow the backlog and future deliveries of these simulator machines.
And then finally, Danaher, a player in medicine, biotechnology, diagnostics, for example.
Yeah, so interestingly, we own this in our Canadian fund. We own Agilent in the US fund. So we really like this space. And part of it is companies that came out of the pandemic where there was huge demand for bioprocessing, all the research that went into these vaccines, that's now pulled back. And so we're lapping these really strong quarters, and the market's not liking that. They never like a negative rate of change on revenue, but a company like Danaher, which is so high quality, grows by acquisition. So many great CEOs, including ATS Automation, which will have come out of Danaher with these great models of how to run businesses. And so we think it's a great time to look at a name like this that has actually fallen down from a valuation perspective to a point where you can generate some significant long-term returns. And just yesterday they announced, or 2 days ago they announced they won an acquisition of a company called Abcam, which is, they call it the Amazon of antibodies. So it's in the life science space, and they ship these things around to all of the researchers for coming up with new developments or new drugs. And so we think that it's in all the right places. They just have to shake some of the past growth that they've had, and then the street will start to more favorably view the stock. So.
Yeah. Why is it off its highs? Is there any particular reason?
Well, it really comes down to just rate of change. So a lot of these labs were spending tons of money on equipment or bioprocessing, and so that's come off a little bit now. Part of it's capital markets. There's not as much money to go around. There haven't been a whole bunch of new IPOs for biotech companies, and so that spending has pulled back a little bit. China's been a big impact, so slowing growth in China has had a big impact on a number of companies, Agilent and Danaher and a bunch of other sectors. So it's just something that we're just going to muddle through this environment. But when we buy something like Danaher of this caliber, we expect to hold a name like this for 5 to 10 years.
James, thanks very much indeed.
Yeah, my pleasure.
First idea, Freehold Royalties. You spent time working as an engineer in oil and gas, and why would you be attracted to this one?
Super cheap, rock bottom production costs. So again, it's a royalty company. So, yeah, we talked about Athabasca earlier and the fact that it's a relatively high cost producer. Well, Freehold Royalties cost of production would be like 1/10 of what it costs Athabasca to produce, right? And so, because basically it's kind of almost like a real estate company. They own the property, and then oil and gas companies basically farm into the property for the right to produce the stuff, and they just give a portion of their production to Freehold, and so Freehold's only cost really is just running the office and the administration of all this stuff. So their costs are on the order of like $5 a barrel. So even in 2020 they were making money, and so. Every environment they make a lot, and it's paying a 7.5% dividend yield right now, and that's probably at current prices probably about 60% of free cash flow. So, no concerns. Even if oil goes to $40 a barrel, they're not going to cut their dividend because unlike some of the other oil and gas producers that aren't royalty companies, that at that price they may have to cut dividends.
Eventually, though, if oil does slump, oil companies will stop drilling and stop paying them lease money.
Well, then this is it's a commodity industry, right? And so when prices go down, drilling goes down, and they just spend less capex because they don't have as much money, and the economics go away again. I used to do this for a job as a production reservoir engineer, and so you'd come up with a project. This is how much oil it's going to produce, and this is the price to drill the well and complete it and tie it in, and you run the economics. And if the prices are high, they're really attractive economics. If the prices are low, they're not very good economics, and so you won't spend the money. So it's as simple as that. So. But the beauty of the royalty companies is they just sit back and collect their royalties from the producers.
One thing always interested me about the oil and gas industry, as far as I know, the industry worldwide leaves a lot of the oil in the ground because it's not economic to get out. But at higher prices, it could go back and get it.
For sure. And there's this whole thing of enhanced oil recovery, and that's like. People talk about carbon capture. Well, Canada's a world leader in carbon capture because we've been doing it for 30 years in southern Saskatchewan in the, I forget, the Weyburn field, I think it is. And so they've been taking CO2 and injecting in the ground to recover more oil and gas, and the CO2 gets left behind in the reservoir. And so, we've been doing it for 30 years. So we have a super green oil and gas industry in Canada, which the environmentalists seem to totally ignore. But anyways, there's just lots of places to use CO2 in enhanced oil recovery. So it's and it takes recovery from maybe 10% up to at times 50 or 60%. So you get a lot more out of the ground.
Polaris Renewable Energy, PIF, is this geothermal energy?
Yeah, it's green energy. So they have a number of projects. Okay. They're in about now five different countries in South and Central America. The original project was a geothermal project in Nicaragua, and it's been up and running for over 10 years now, and just producing more. And they actually are continuing to enhance that project, bring on slightly more power out of the project, and so. That was their initial project, but they have hydro in Peru, and then they also have some solar projects, Dominican Republic, Panama. So, over time, the company's just built. They do what's kind of off the radar screen for the really big guys like the Brookfields who can't delve in these small projects. They're a small company. This is a sub $500 million company, and so they can invest in these small projects that is just too much trouble for the big guys to get involved with, and so there's a big playing field for them to get involved with, and they've just continued to add to their portfolio of properties and build the business, and it pays you a nice dividend of around 5%. Every year, and they continue to build their free cash flow over time, and it's cheap. It trades at probably about half the valuation of all the other green power producers out there.
And then finally, Keyera, a big player in, I'm trying to remember, condensate, I think, and natural gas processing. Anyway.
The essence of the business is mostly natural gas plants and processing, but they're also involved in some liquids and that sort of thing now. And it's one of the less levered companies in the energy midstream. And again, I go, this is critical infrastructure. And again, these stocks, we talked about the fact that companies like Enbridge are at depressed valuations, Keyera and all the midstreamers in a similar situation. These are great midstream business. If you look at how they've done over the last 20 years, this is just like a dead steady business, because all that oil and gas being produced has to be processed someplace and sent to market somehow. And these guys just process it and they get paid for it. And so these are really good, steady businesses, and they trade at kind of 10-year lows on a valuation basis from where they've historically traded at. And you get paid great dividends. Got a 6% dividend yield, and they continue to build. In fact, there was a transaction this morning. Tidewater sold. Their gas plant in Pipestone to AltaGas, and Tidewater is ridiculously cheap. It's like 5 times EBITDA, and this was just a value arbitrage because AltaGas trades at 10 times EBITDA. So they used high valued currency to buy a really good asset. The Pipestone gas plant is fantastic, and because Tidewater is cheap, they can make it an attractive sale for them. Trading sell at a higher valuation than their stock trades at, so it's good for Tidewater, and for AltaGas it's cheap compared to their trading multiple, so it's accretive for them. So this is great, but it just underlies the fact that these assets, by and large, in the market are trading at depressed valuations, and so you're starting to see these transactions happen, and I think it's indicative of the fact that the whole sector's undervalued, and in 5 years people look back and go, why wasn't I paying attention to this stuff?
Is it part of the problem, though, some pension funds just don't want to be seen investing in hydrocarbons?
For sure. But, at the end of the day, over time, I've been a portfolio manager for 30 years, Andy, and people get into these crazes like, I'll never invest in this for this or that reason. And then if you underperform for too long, you get fired by your clients, and they just say, that's nice that you say you won't invest in this stuff, but I'm getting left behind by all this other stuff. So, you know what, I'm going to hire another manager that will invest in this stuff. So, investment professionals tend to be a bit malleable. That way they realize that they can't be too altruistic for too long.
We'll leave it there. Alex, thank you very much indeed.
You're welcome.
Alex Roos of Arrow Capital.
Welcome back. Rob Lozon of Middlefield Capital, has been on the show this entire hour, and now it's time for his top picks. So let's get to the first one right away here. This is Chartwell Retirement Residences. Why did you choose this one?
Yeah, we've got a strong franchise at Middlefield, both real estate ETFs and mutual funds. So we've been in the REIT space for over 20 years, and when we looked at earnings estimates going into 24. And cash flow estimates, Chartwell actually screened as having one of the highest growth rates, expected earnings. And so typically stock prices will follow if you're growing at a rapid pace. The reason for that is they're starting to see occupancy trends increase. So a lot of people came out of retirement homes during COVID and now are feeling a lot more comfortable to go back. So if they can get occupancy back to where it was pre-COVID in that 85 to 90% range, all of that extra revenue basically falls to the bottom line and helps their margins. So, we think where it's trading at a 80% or like a 20% discount to NAV is too punitive, and we think it's probably a $12 to $12.50 stock, $12 sometime in 2024. So I really like the entry point here.
Okay, this next name you'd kind of alluded to when we were talking about access and at least exposure to the Asian markets. This is Medtronic, and why did you choose this one?
Yeah, we really like med tech. So in healthcare, in our healthcare funds, we often have a barbell strategy between pharma companies and then med tech. And we're really excited about med tech because, again, surgeries, all of that was shelved during COVID. They're starting to come back. And you can see the share prices all dropped 20, 30% during COVID. So things are stabilizing. They do insulin pumps. They've got robotic technology for surgeries. And pacemakers for your heart. So, we think the low is in on Medtronic, and it does sell a lot into Asia. So there's a way to get some exposure there. It's trades 16 or 17 times earnings forward, and it should trade at 20 times. So I think there's 25% upside in this name over the next 12 months.
And I suppose both of these last names, Medtronic as well as Chartwell, are also getting a lift from the aging population as well.
Yeah, that's just a natural demographic tailwind that will help both companies over the next 5 to 10 years for sure.
Mm-hmm. Okay, let's get to your last top pick, and this is the one that you promoted when we were talking about Pembina pipelines, but Enbridge would be your top pick here.
Yeah, just looking at their history of growing their dividend every single year. So expect another dividend bump. I think they usually bump it in January or February. But it's yielding over 7%. And look at that chart is just basically what interest rates have done to the stock. And I think once we see interest rate cuts, we'll get a few, in our opinion, next year by the Bank of Canada and a few more in 25. The stock will be back to $52. So, if you can lock in a 7 yield and 8 to 10% upside in the stock over the next year, that's a pretty good total return. So I think it's a really low risk way of playing in energy infrastructure. And again, because we like dividends so much, a 7% dividend yield that's tax efficient for Canadian investors is quite attractive.
Just even thinking about pipelines and the difficulty in getting new infrastructure into the ground, as we've seen even with the Trans Mountain expansion, why would you choose Enbridge, say, over Pembina or TC Energy and all the other players that are in this space?
I really like Enbridge's thematic on the energy evolution or transition. So they've got technology in carbon capture, they're involved in LNG, they're involved in hydrogen. Like, they'll be able to move carbon and hydrogen through their similar pipes that they have in the ground now, over the next 20 years. So, they're going to be part of that energy transition. I really like that thematic as like an added growth area on top of their base business.
All right. Well, thank you so much for all of your time today.